It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Well, we're going to continue the discussion we've been having for the last several weeks regarding tariffs, because that is the topic of the day and the one that nearly everyone is concerned about, particularly from an economic standpoint. The key point I think you need to understand is this is far more than just tariff policy, and it's really boiled down to U.S.-China trade. The markets are really not concerned about tariffs and trade with the U.S. and the rest of the world, because it's pretty much been settled that tariffs to the rest of the world are going to be likely at the 10% base level. The real issue and concern is with China. And again, this is far more than just tariff policy. It's really about trade, bringing back manufacturing to the United States, national security issues, who's going to dominate the economic trade in the future, particularly when it comes to future technology, for example. And there's no doubt that the Chinese Communist Party has waged an economic war against the United States on multiple fronts, from economic to cyber, political, psychological, and America is finally fighting back. If you listen to the rhetoric and what the Chinese Communist Party openly admits, is that they feel a sense of shame that the past century has been dominated by Western societies, particularly the US. And they want the next century to be dominated by China. China does have a long history of being a dominant power in the world. The Chinese Communist Party, for the most part, does not see a coexistence per se with the United States, but has pursued a policy of dominating. And for example, in this recent tariff scenario, when the U.S. raised tariffs on China, they retaliated by raising tariffs back, and then also upped the ante by banning rare earth metals to be shipped to the United States. China dominates rare earth metals market worldwide. Many of those metals are needed for aerospace industry, military equipment, etc. And as I stated in a previous show, if China has the ability to prevent the United States from obtaining items it needs to maintain our economy, maintain our sovereignty, maintain our national security, who's the master and slave in that scenario? Clearly, so far in this situation, China is the master. They're in control. So again, this is far more than just a tariff war. It's evolving into an economic Cold War, much like we saw with the Soviet Union and the United States that went through a several decade period of a military Cold War. That was all about who was going to dominate as a world power militarily. This Cold War with China is all about who's going to dominate worldwide economically. Clearly, there's a decoupling of the two economies. Currently, tariffs on U.S. products into China have a 125% tariff, and products from China into the United States face a 145% tariff. Now, there are some exceptions. It's unclear how long those exceptions will last, but this uncoupling of the two world's largest economies in many ways is much like a divorce. Now, a divorce can be amicable if both parties decide to make it that way, or can become very messy if one or both parties decide to fight back. China also has now recently warned countries against striking trade deals with the U.S. at China's expense. China fighting back or fighting for its own interests. The question that's on everyone's mind and on the markets is how long will this last? How difficult will it be? How messy will this divorce between the United States and China become? Will we evolve into an economic Cold War, much like we experienced with the Soviet Cold War militarily? But clearly, China is in no mood to stand back and allow the United States to dominate economic world trade. They are fighting back so far every step of the way. My concern as we continue to move further along in this process is that China will dig in its heels and fight back with everything it has economically against the United States. The U.S. economy is quite a bit larger, is much stronger by nearly any measurement you want to use. So if it came down to an economic Cold War, China would be at a disadvantage. From tariff policy to trade deals with other countries, etc. I'm becoming increasingly concerned, though, that despite the disadvantages that China has, they also have some strengths that they can play. Certainly in the short term, they have advantages over the United States, like dominating rare earth minerals worldwide. The U.S. is taking steps to alleviate that, either with gaining access to rare earth minerals via Greenland or a deal with Ukraine, either of which would resolve the situation for the United States significantly. So I don't think that China is going to be able to hold it over the US's head and dominate or control rare earth metals, for example, and other things long term, but they certainly have the advantage in the short term, and so far are willing to use those advantages. They're also a communist country, a totalitarian regime who wants to maintain control and power. And they may see the only way to maintain power is to fight back, to attempt to maintain control as much as possible, economically speaking. So this certainly could become a lot uglier, a lot messier before it eventually gets resolved. And that's the question the markets are looking at too. Again, how long is this going to last? It looks increasingly so that this could last quite some time. Significant changes will be happening. Made in China labels will effectively disappear. Chinese officials already are encouraging office workers not to work so hard because they want to increase consumption. In fact, in 2019, Jack Ma, founder of Alibaba, one of the largest companies in China, famously defended what's known as the 996 work culture in China. That's working 9 a.m. to 9 p.m., 6 days a week. He described it as a huge blessing. Well, if you're working 12 hours a day, 6 days a week, that doesn't leave much time for relaxation, free time, or consumption. Significant changes are going to happen both in the US and China, and some of these changes will be challenging to accept and difficult to swallow. My recommendation here is simple. There's a lot of uncertainty. The markets are demonstrating that significantly. Historic volatility, both ups and downs. We're seeing daily moves in the stock markets upwards of 7, 8, 9% in a day, both ways. Companies are in a wait and see mode. It's impossible to predict what really is going to happen. The only certainty at this point seems to be more volatility until eventually the situation between the US and China gets resolved. The dust clears, so to speak. The best thing to do, I think, for most people would be to get out of the way, reduce the market risk, reduce the uncertainty, reduce the impact to your portfolio to this extreme volatility and wild swings, because the market has significant capacity at this point to move a long ways. And it is, despite all the volatility, still at the high end of the historical spectrum. So the risk to the downside is significantly higher currently than it is to the upside. Protecting your downside using whether it's your personal bank or annuities to mitigate your risk, eliminate market risk. That's one of the strengths of these products. This is the golden era of fixed assets. Another question I get constantly is how is this volatility in the bond market affecting fixed assets? And the answer is it's benefiting these companies tremendously. We're seeing some of the highest rates and returns we've seen in over 40 years. One of the key points about bonds is insurance companies invest in bonds heavily, but many people do not understand the difference between the bond value and a bond yield. A bond yield is what interest rate a bond pays. The bond value is, of course, the value of the bond if you were to sell it. Well, if you hold the bond to term, the value of the bond does not matter. So when we see news and articles talking about bond values dropping, bond yields are strong. And there's a number of reasons behind that why it's expected that bond yields will continue to stay strong for the next 3 to 5 years, if not longer. Vanguard has projected for the next 10 years. I'm going to encourage you to stay tuned in the next segment because I'll get into some of the reasons why it is the golden era of fixed assets, why protecting yourself and mitigating your risk is more important than ever because of the extreme volatility and uncertainty that we are dealing with currently in the markets due to this economic Cold War that we're dealing with between the U.S. and China.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I have been seeing more articles than I've seen in years regarding recession. And in some ways, recessions are a self-fulfilling prophecy. So what it boils down to, the markets, in particular the stock market, the bottom line is the value of an asset truly comes down to what someone else is willing to pay for that asset at any given time. The stock market is famous for factors known as fear and greed. When the majority of people are feeling greedy, it tends to go up because they're willing to buy. And when the majority are fearful, prices tend to go down because they're fearful of the future. This avalanche of articles, and it keeps increasing each week as I am reading these articles and researching. They keep building a case more and more towards recession is on the way. In fact, that's the title of one of these articles that I was reading. And that's the title of the article. It says a recession is on the way. Now, the point they make is a recession is coming. How do I know this? And his statement is because this is what happens. In that regard, he's correct. If you go back the past 170 years or so, a recession has occurred on average about every 5 to 7 years. We truly have not experienced a recession since the 2008-2009 Great Recession. Yes, there was a short-lived recession in 2020. It was man-made with the COVID era shutdowns and quickly recovered because of the Federal Reserve flooding the markets with money, printing trillions of dollars literally and flooding the economy. So we literally had a man-made recession with the shutdowns and then a man-made recovery with all the money printing. So sugar high. We are now starting to feel the effects of that excess money printing, as we've discussed on the show many times. This sugar high of easy monetary policy is definitely behind us, but we're feeling the after effects. Something was going to cause the markets to correct. Something was going to cause a recession to occur. Are we in one currently or not? Some argue we are already, but something will be the trigger. It seems like the tariff policies and the economic Cold War, as I call it, with China that's developing, might be the trigger to result in a downturn, an economic downturn, a market downturn. It certainly has caused a lot of volatility. There's no argument there. Will it result in a recession? Has a significant capability of doing so. I think the point this article is making that it's going to be interesting to see how businesses and consumers react when we are indeed in recession. Because it's been over 15 years since we've had a real recession, a lot of businesses, a lot of individuals are frankly out of practice. Recently, many CEOs have expressed concern. Investors reducing their risk to equities. Many institutional investors are demonstrating concern. Consumers are expressing worry. Employees are concerned about jobs. The environment is ripe for a recession. There's no question about that. Now, if we do enter into a recession, there will be job losses, businesses will close, stock prices will go down. Even a mild recession is not very much fun. Preparation for that is key. If you have debt, you want to reduce it, particularly higher interest debt, having an emergency fund in place, having some savings. Your personal bank happens to be a great tool for that, by the way. I often share this key point. Having some money, an emergency savings, is critical. You certainly should have at least 3 months' expenses, if not more, set aside just in case. What if you have a job loss, a medical situation? You have to replace a car or fix the roof. Any number of emergencies that can come up unexpectedly at any time. No one ever said emergency funds had to be in the bank, which is where most people keep their emergency funds. Emergency funds only criteria are they need to be safe and liquid. Your personal bank currently is paying 6% plus interest, insured, guaranteed, income tax free, and highly liquid. In most cases, 80% or more of the funds are available to you day one. Many of my clients use your personal bank for their emergency savings in lieu of a checking or savings account in the bank because they get a far greater interest on that money. It's safe, it's insured, it's guaranteed, and it's liquid. It meets all the criteria, and they get a better return. If you want more information on that, certainly contact me at yourpersonalbank.com. I've made this statement repeatedly. I agree with this article that a statement I make to people all the time is, the markets will correct. Why do I say that? Because they always have. What no one can tell you is when, how much, or for how long. That's the uncertain part of that equation. Protecting your money from the downside helps alleviate that issue. And when the markets and the economy are ripe for correction, is when it becomes more important than ever to protect the downside. Having the money liquid so you can take advantage of the eventual recovery is an awesome way to increase your wealth. Oftentimes, this is where wealth is built. I could go on and on about these articles predicting recessions. Another one here is discussing, will the Federal Reserve be wrong on interest rates again? They have a history of being late to the party, then overreacting or oversteering. If you go back for decades, that has been the standard operating procedure for the Federal Reserve. Will they make similar mistakes again in the future? most likely. They're human beings like the rest of us. And in my opinion, they have difficulty separating the forest from the trees because they're too involved in looking at things too closely instead of taking a step back and looking at the bigger picture. I think they get caught up in the minutia of the details of monthly and quarterly reports. And they have so much information, so much data at their fingertips that it's overwhelming, frankly, which, in my opinion, makes it even more difficult for them to make effective decisions regarding interest rate policy, quantitative easing, etc., or quantitative tightening. Here was one that I thought this is kind of a fun one in terms of potential recession, and that happens to be a Business Insider article discussing the pepperoni price index. The subtitle is "It's a Sure Sign We're About to Enter a Recession is Frozen Pizzas." And they point out that when frozen pizza purchases increase, that is a very good early indicator of recession. The reason behind it is cut back on going out to eat during tougher economic times or recessions. Yet they still enjoy a good quality pizza. So the demand for premium frozen pizzas goes up typically right before a recession because people are stocking up, stick them in their freezer, and then they can still enjoy a good pizza, good quality pizza for a much lower cost than, say, going out to eat. So whenever people are feeling pinched economically, they turn to the grocery store frozen section. They use an example in the midst of the Great Recession, frozen food sales grew by 3%. And frozen pizza has always been a good indicator of that. It's a very popular tool. So I thought that was kind of an interesting and fun measurement to give you maybe a hint or an idea of what may be coming down the pike. And their prediction, of course, for this Business Insider article is that we are likely headed into recession. Much like many of these other articles continue ad nauseum to share. And I believe, as I stated earlier, that it at some point becomes a self-fulfilling prophecy. Once a majority of people believe that we are or headed into recession, it inevitably becomes reality. Asset values are all about perception. What is the price someone is willing to pay for that particular asset at that particular time? And a lot of that is perception and sentiment. If you are feeling that the country, the economy is starting to feel a pinch, like many of these people that are buying these frozen pizzas, you may want to reduce your market risk if you have not already done so. And rather than just moving to cash or bonds, why not consider your personal bank to earn a higher dividend, tax-free and highly liquid? This is what many banks and institutional investors do. And I had some questions regarding some of those very issues with a listener just today that I'm going to share in the next segment. I think you'll find very interesting. So I'm going to encourage you to stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me at yourpersonalbank.com. Before I get to some of the questions that I was asked earlier today, in fact, by a listener that I found very interesting, a few other quick thoughts about the economy, where it's headed, what is the likelihood of us heading into a recession. Here's a few more tells. Warren Buffett has dumped 2 U.S.-based investments he's told millions of Americans to buy for years. I often share some of the actions that Warren Buffett, Berkshire Hathaway does in their stock trading. Warren Buffett is known as the Oracle of Omaha. It's public record. There's no question that he is one of the best investors in history. And I think it's valuable to at least pay attention to what he's doing. You may not necessarily want to follow every step he makes, but clearly he's been right more often than wrong, so it's worth paying attention to. Well, it turns out Berkshire Hathaway, Warren Buffett's company, has sold their entire positions in their S&P 500 EFTs, which they had held previously for years. Many people over the years have asked Warren Buffett for investing advice in terms of what they should do. He's often recommended, if you don't want to pay close attention to the markets on a consistent basis, to invest in the S&P 500 and set it and forget it, so to speak. But even he now has sold off his positions in the S&P 500. I find that quite interesting. And another piece of news that I found telling is many wealthy people now are quietly selling several of these assets, including commercial property funds. Many of these are being wound down. I have a number of clients that have faced cash calls because commercial real estate already is in a full-blown depression, particularly office space, retail space. Those are areas that are just getting hammered significantly. Second home demand is disappearing. According to Redfin, it turns out that a significant number of wealthy Americans purchased second homes with the purpose of holding these homes for their appreciation. Many of them use them as vacation properties, but their main purpose was to obtain the appreciation of the real estate. That has certainly changed. And as they point out in this article, second homes are a discretionary luxury item. A number of the wealthy turn to become sellers. It often precedes a broader slowdown in the housing market. Auctions for fine art have fallen by about a third in the past year or so, and many wealthy are now selling and liquidating collections while they still hold some value. Art prices correlate with the wealth effect significantly, and family offices have been trimming back their tech holdings. For example, Microsoft co-founder Paul Allen has cut his Microsoft weighting from 17% of his portfolio down to 12%. That's a significant reduction and a significant portion of his portfolio, this was done to reduce risk and exposure to the tech sector. I bring these things up because, again, if you watch and pay attention to what many of the wealthy are doing, the major investors like Warren Buffett and et cetera, you can get an idea of where things are likely heading, or at least where the perception is. Another interesting fact is the spread between 10-year treasuries and mortgage rates is historically high. Most people, I find, think that the interest rates that are set by the Federal Reserve affect mortgages. They do indirectly, but the reality is the 30-year fixed mortgage is most impacted by the 10-year treasury yield, or the interest that the 10-year treasury bond pays. Typically the 30-year mortgage averages around 2% more than the 10-year treasury. When the spread is wider or higher, that usually indicates more risk. When it's lower, less risk. Currently, the spread of the 30-year mortgage is on the high side. It has not been this high since the late 70s, 1980, when we had 20% mortgages. The investors in the mortgage industry, mortgage-backed securities, are concerned, and they're demanding a higher return to offset that risk. So again, it's another indicator that we're in volatile times. Risks are high, and investors are concerned. Also, on the real estate side of things, Price drops are occurring in 33 of the largest housing markets. We're seeing year over year price declines of upwards of 4% in some markets from just a year ago. And from their peaks, we're seeing reductions in a number of markets of around 10% from the peak. And in Austin, over 23%. It has had a significant price drop from the peak. And Zillow has now turned full blown housing market bear by stating their projections between March 2025 and March of 2026. They are now projecting an overall reduction of housing prices. That doesn't happen very often where housing prices go down, but it certainly can be understood when you look in the context of housing prices have gone up so far, so fast over the last several years. Much like the stock market has done, some correction has to be expected and should be really no surprise to anyone who's really paying attention at all. Because of all of these reasons and the concerns about the US and China trade policies and the potential of a recession and the extreme increases we saw both in the stock and real estate markets over the last couple of years, more and more people are concerned about a correction, a recession, an economic downturn. They're concerned about their investments, their portfolios, reducing market risk. I'm having people reach out to me who frankly have not considered a safe money option for a number of years. It's been 15 years since we've had a real recession, the 0809 one. They're out of practice. They don't remember. Many of these assets that have been there all this time have been available, but they just weren't paying attention to them, now starting to. The fact that bond yields are strong and expected to continue to stay that way for the next 3 to 5 years, if not longer. That's not me saying that. That's Goldman Sachs, JP Morgan, Vanguard, and others. We're in the golden era of fixed assets. Higher returns than we've seen in over 40 years. Some of the questions I get frequently is, well, how is it guaranteed? How safe is it? Those types of things. FDIC defines certain assets as tier 1 capital. Those are considered by FDIC to be the safest assets that a bank can invest their money in. Any FDIC insured bank is required to have 25% of their portfolio or more in these tier 1 assets. Now, what are tier 1 assets? There's only 3 assets that fit into this category, according to FDIC. That happens to be cash equivalents. These be like savings accounts, money markets, those types of things, and cash value in life insurance policies. That's it. Banks look for cash flow, and putting money in cash gives them no cash flow. So they prefer not to have much in cash because there's just no return. Savings, money markets, things like that certainly are highly liquid, tier 1 capital, safe according to FDIC. But even a high interest savings account today probably only going to get you 3 or 4% return even with a large balance. This is why banks are so favorable to cash value life. So we have companies paying 6% plus currently, insured, guaranteed, tax-free, tier 1 capital. There's an entire category of insurance called bank-owned life insurance, also known as BOLI for short. Banks invest in this literally by the billions of dollars every year. And that's one of my focus and goals of this show is to educate people. Look, you can like banks or hate them. It doesn't really matter to me, but we can agree they're savvy about money and we can learn from them. This is a tool that's often used by banks and other financial institutional investors, and you can take advantage of this also. There are a significant number of benefits. In addition to the safety, it's highly liquid. You can also create positive arbitrage. You can access funds from these policies on a tax-free basis if done properly, which we teach, of course. Most often, funds are accessed through loans, either through bank lines of credit or policy loans. And historically, the dividends earned are higher than the cost of the borrowing or the interest charged. The historical average over the last 40 plus years is about 2%. And some people make the mistake of thinking that that's not a big deal. It's a really big deal. I'll use an example. Let's assume you have the ability to invest in an asset and it gives you a 10% return. You can invest in that asset and get your 10% return, or you can fund it into a policy, borrow against that policy, and invest in that asset. Now, if you make a 1, 2, 3% positive arbitrage, the difference of the dividend you're earning minus the interest cost you're getting charged, you can add that to the return you would receive on the investment. So again, if your investment return was 10%, and if you picked up the historical average over time of 2%, positive arbitrage, the difference of the dividend you're earning minus the interest rate you're getting charged, your now overall total return is 12%. You have increased your return overall by 20% on your investment. Show me any business, any investor, you increase their returns by 20% annually on average, they are excited. That is a really big deal. And that's the power of your personal bank. Contact me for more information at yourpersonalbank.com if you'd like to look into this further for yourself and reduce your market risk all at the same time. Stay tuned in the last segment. I have a few other key thoughts on some things that are going on with our country and the economy I think you'll find very interesting. So don't miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to contact me, you can do so at yourpersonalbank.com. Yes, you'll reach me, yourpersonalbank.com. I almost forgot. I've got one more article regarding a recession ahead that I think is very valuable. This was a Forbes article discussing surviving the recession, tips from the experienced. I found this article absolutely fantastic, and I think part of the reason why is this is my 25th year in the financial industry. If we go into recession, this will be my third rodeo. I was in the business through the dot-com bubble and then bust, the housing run-up and the Great Recession, this current run-up of assets through easy monetary policy, and we'll see what happens. As I stated earlier, it's increasingly likely that we're headed into some type of recession, economic downturn, whatever you want to call it. But here's a few points about this article I found very, very valuable. And they point out the point of the article is not to examine why recession arose, but rather talk about how to survive it. And the writer of this article points out he's survived several of these recessions, much like I just shared. But he's made a few key points. One is hope is not an option. He makes a very valid, a very important point here. He says, whenever there's a bust, there's always hope that the bust will be short and things will return to boom pretty quickly. Granted, sometimes that does occur, but typically not as quickly as the person with their business or their investors hope for. A business owner or investor may have a deal that's going on when the economy turns south, markets turn south, and they may even go underwater during the bust, but the potential of the deal is so good they don't want to let go of it. Oftentimes, they might even have to carry some leverage on that deal. And as he points out, the prudent thing, though, is when a bust arises, get rid of that project as quickly as possible, sell that asset as soon as possible, with as little pain as possible. Unfortunately, many people have blind hope, keep throwing good money after bad, or wait it out and hope it gets better. And inevitably, they ride the deal all the way down where it finally forces them into a situation where they have to close that deal out or sell that asset. He points out when times are good, it's often a good wager to bet on today's investment against tomorrow's profits. That's true. But when times are bad, the smart bet is to take the small loss today. It's better than taking a better loss. It's better than taking a bigger loss tomorrow. The folks who survive busts are those who see early that the economic winds are shifting, and they're able to unload their potentially sour investments quickly. The ones that get killed are the ones that hope things will turn around quickly, but really don't have a plan B if it doesn't, or they wait too long and then they have to sell off at distressed prices. The thing is, during recessions, and I was in the banking industry, I can validate this. When times are good, borrowing money is easy. Businesses have numerous lenders willing to issue credit. But in a bust, it goes away quickly. And if you can find a lender during a bust, typically you're dealing with very high interest rates or hard money lenders even. So if you think you have a business situation or you need to borrow money to keep things afloat until the economic climate improves, you're probably wrong. It's going to hurt you. There's a thing called flying to the crash. Pilots are taught this. If they realize they're going to crash, you want to make a controlled crash. That's called flying to the crash. This applies in business and investments when things start going badly. And if things are going to collapse for whatever reason, the best thing you can do is make a controlled crash. Take small losses early, quickly, to prevent bigger losses down the road in the future. It's one of the biggest mistakes business owners, investors make when the economic situation changes. If you have loans, lenders will often work with distressed debtors if things can be done quickly so they can realize the best value of their collateral before the prices deteriorate further. And look, I understand it's painful. I've been there. I've lived it myself personally. I've told the story on the show more than once. But liquidating distressed assets quickly or before they become distressed as soon as possible, you avoid busts that often will trigger something known as a debt spiral, where the failure of one business or one asset will trigger the failures of others, which then trigger more failures. It's a cascade, like a domino effect. It's often said a rising tide lifts all boats. But so does a lowering tide strands all boats. And another saying that's common is the stock market goes up like an escalator, but goes down like an elevator. Fear is a powerful motivating factor. You can look at any chart of any economic cycle, and you see the downturns most often are far faster, far more aggressive than the increases. The key during a downturn is really about survival. Take the losses now quickly, small losses now to prevent bigger losses in the future. Because here's the other thing I see most investors do. I've seen this repeatedly over and over again. They have assets, it starts to go down, they're concerned about the values. Like this article discusses, I call hopium. They hope it's going to come back. They don't really have a plan B, and they end up writing it down. Where if they recognized, hey, if I take this small loss now because the likelihood of a bigger loss in the future is significant, if that's the case, you're better off taking the small loss now. Because if the prices do drop in the future, can't you re-engage and purchase that asset at a much lower price? Look, economic cycles happen. Downturns happen. We're going to have another one, and we're seeing a lot of volatility now. There's certainly the potential of things going, far greater potential of things going down at this point than going up. Why not bite the bullet, take the small loss now, put it into something like your personal bank so it's insured, guaranteed, tax-free, highly liquid. You can earn some interest on it while you're waiting for the next opportunity for the correction to occur. And you could oftentimes purchase assets at a significant discount at some point down the road, which is where real wealth oftentimes is built, folks. That's what I've seen personally, firsthand, from my 25 plus year career. A couple other key points about this article I find very interesting, Surviving the Recession, Tips from the Experienced. And that is, when times are good, debt is generally an acceptable answer. Rates of return you can make from your business or financial investments oftentimes are greater than the rate at which you borrowed the money. But if you're borrowing money to invest in assets or your business and you see an economic downturn, the debt growth arbitrage operates backwards. It often costs more, and you can, again, get yourself caught up in a debt spiral. The solution is to liquidate assets, liquidate investments, liquidate deals whenever possible, and use them to pay down debt if you have that. I've survived this personally. I've had multiple businesses. I survived the 08-09 Great Recession, for example, where I had one business, a real estate business with a lot of debt, and another business, a financial agency with zero debt. Guess which one survived the recession? Debt kills when the economy turns down. Also in the financial agency realm, after the 08-09 Great Recession, about a year or two later, approximately half of my competitors had gone out of business for various reasons. Certainly, I would assume debt was one of the big causes of their failures, which meant we increased our revenues significantly because there was less competition. So by being debt-free in that business, it allowed us to survive the downturn, come out on the other side stronger than ever, and double our revenues within a couple of years. Liquidity is king during a recession. It's another point in this article. And your personal bank allows you the high liquidity. That's what I point out all the time. Your money's safe, it's insured, it's guaranteed, it's tax-free, but it's also highly liquid. And those that have the money available to pick up distressed assets at fire sale prices oftentimes is where they truly build wealth. And as this article even points out, some assets will bottom out fairly quickly. But most assets, particularly real estate, usually take a couple of years before prices find a bottom. There's a backlog with lenders going through the process of liquidating assets, bankruptcy courts, liquidation of debtors' estates, all types of things cause that delay process, and it takes longer than many people often realize. I found this article fascinating and on target that if indeed we do go into a recession, as many of these articles and experts are now predicting is a very high likelihood, reducing your market risk, increasing your liquidity, access to monies safely, flying to the crash. In other words, liquidating assets as soon as possible when they're showing some signs of loss or potential loss, to be able to prevent taking a small loss now to prevent a larger loss later, is where people truly take advantage of corrections in the markets, in the economy, recessions, etc. Your personal bank is a fantastic tool to allow you to do that safely, have that money available, insured, guaranteed, tax-free, highly liquid, to take advantage of those opportunities when they occur down the road. If you want more information on this, how these companies have been able to pay dividends for, I have multiple companies, A+ rated, tons of cash value, have literally been paying dividends since before the Civil War. This is a powerful financial tool. It becomes even more powerful during times of volatility, which we are in now. And if we do end up with a correction or recession, this will be the best financial tool you could own. It will give you the most options available to take advantage of future opportunities. You won't have to ride the roller coaster down like many people will do, inevitably. But then you'll be able to take advantage of those opportunities that will come along and truly enhance and improve your financial situation. Contact me at yourpersonalbank.com for more information. Stay tuned to the Your Personal Bank Show next week for some more great information And as always, as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.